Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for September 21st, 2020. Please see our disclaimer for important information. Well, we certainly do have a lot to talk about this week. We've had a little bit of correction in the equity markets, a little bit of rotation out of some of the high-flying sectors that we've seen. We had a Fed rate decision, which I think is setting the tone for quite a while. And we've also had a rise in global coronavirus cases. Actually, it's a trend that's been ongoing, but it's just getting a little bit more headlines in some of the areas, and particularly in Britain, where there's conversation about reinstating some of the restrictions, et cetera. So causing a little bit of strain on the market. So let's jump into it, shall we? For the week, the Dow Jones was slightly negative. The S&P was also down about 0.6%. NASDAQ was down about the same, and the Russell 2000, representing some small caps, was up about 2.6%. So, even though we had a little bit of chop in the market, just kind of reflecting on this massive turnaround, the Dow, which had its fastest ever drop from a record high to a bear market. It was, obviously down in March, it was down 35% in 6 weeks. And then since then, it's had the best rally over the last 5 months in 80 years. And then, something else that we highlighted in our charts of the week, the S&P went from trough to basically from record high to bear market, then back to its record high in 126 trading days. And that usually in a bear market takes about 1,500 days for the market to kind of retrace its prior peak. So, I mean, all of this continues to evolve and happen very, very quickly. But overall, stocks fell for the third straight week for the first time in almost a year. And we had mega cap stocks, and particularly mega cap technology stocks, were down, and some of them were down somewhere close to 5%. And the interesting thing is, for all of this activity here lately, what's happening is that the cap weighted S&P 500 index, which is what the published index is, that's where most of these large technology companies that constitute a large percent of the index have had so much influence. They have pulled back, and so the market breadth is actually improving. And we've been talking about that over a number of weeks. And what does that really mean? It just means that whereas we have the top 5 companies in the S&P 500 that comprise 23% of the index, the average of the top five companies is 14% usually. So, I mean, we've had this huge outsized influence by these large FANG stocks, technology stocks, and they have really controlled and dictated this recovery in the index. Well, now that they've kind of sold off a little bit, there's broader participation in the market, and that's very healthy. We want to continue to see that. Anyway, so just looking at the other numbers, month to date, the S&P 500 is down about 5.2%. Dow's down about 2.7. NASDAQ's down about 8.3. And then European stocks are slightly up, but they're still down about 6% for the year. And so international stocks continue to lag domestic stock performance. The S&P year to date is still up about 2.8%. The Dow is still down. NASDAQ obviously still up. So just looking around some of the other markets, bonds, the Barclays Aggregate Index was up slightly for the month, and still up about 7% almost for the year. Real estate continues to be down by almost 12%. Crude prices, which actually had a fairly decent week. Month to date, crude prices are down about 3.5% and down about 33% year to date. Gold continues to perform well, but gold's really kind of consolidating in that 1900, 1950 range after that huge rise. The dollar index month to date is up a little bit, but it's still down about 3.6 for the year. And then Treasury rates continue to kind of hover in that 55 to 65 basis point range. Ended last week, 55 to 70 basis point range, and it ended last week at 69 basis points. But like I said, the breadth of the market continues to improve with some of the sell-off in these high-flying technology stocks. The equal weight index was actually up about 0.8%, led by some of the cyclical areas, and then European stocks, I think, continue to be hampered, I think, as I said, by some of the coronavirus caseloads. But retail sales were up about 0.6% in August, fueled by spending at bars. Well, not so much bars, but restaurants, building materials, furniture, things like that. Consumer sentiment index was up in September, close to 80, which is the strongest reading we've seen in consumer sentiment in over 6 months. Weekly claims kind of leveled out. We haven't seen as much progress on the job front lately as we have previously this summer. But the good news is the continuing claims continue to drop a little bit, and they were actually better than expected last week. We're going to talk about the Fed and the economy a little bit. They did leave rates changed, basically 0 to 0.25%, and issued some projections, which we'll talk about in some detail, and actually gave some observations for what they see in the market. But just basically, you kind of look across the broad landscape. The prospects for further stimulus or fiscal stimulus are dimming. Obviously, with the death of a Supreme Court justice, we're going to have to deal with the fallout, political fallout from that. And I think that's going to distract from the ability for Congress to get anything done on the fiscal stimulus side. And then also the fact that we've already lapsed some of the, in fact, of the stimulus from the prior legislation. We are, I think even though we saw some decent consumer numbers, those were August numbers. And I think the risk is that we see September numbers that are below that. But basically, while consumer has been strong, but I think is probably going to weaken with the absence of more stimulus, because we know that there's a large part of the population, particularly in the socioeconomic layers, that are really struggling right now, as are small business owners, which in many respects fall in that lower income tiers. But manufacturing, basically we've had depressed inventory levels, and we've had a fair amount of pent-up demand because of the supply chain disruptions earlier this year. So manufacturing is actually doing well, consumers doing well, but we expect it to slow. So we've got that to kind of look at. Corporate CEOs and CFOs are maybe a little bit more optimistic on earnings. We talk about this in the chart pack as well. And I think that's a big question mark, because we don't know how the election's going to go. But forward guidance is clearly going up. And we do know that continuing negative real interest rates have been a big driver behind the stock markets. They certainly have helped gold prices, and we've pushed the dollar lower. And obviously gold has benefited from a weaker dollar and low yields. So we've had some strong performance there. But just looking at the consumer and kind of reading through all this, I think there's the risk of investors pricing in a higher likelihood of having a vaccine ready sooner as opposed to later. And there's a lot of debate over how that's going to go. We know that there's quite a few therapies. In fact, there are 27 vaccines in phase 1 testing. We know that there's 9 in phase 3 testing, and we have some that are already approved for early or limited use, but they're not widespread. And I think that's what people are missing here, is that it's going to take some time before vaccines are widely available. And I think that and this is even echoed by the Fed, particularly in Chairman Powell's press conference last week, that basically the outlook for the economy will depend on our ability to keep the virus in check, and that a full economic recovery is probably not likely until people are confident to kind of re-engage with society, so to speak, and that's going to be predicated on the wide availability of the vaccine. But we do see, at least in the comments from the Fed, they're talking about the labor market, that we still have 11 million people out of work, even though roughly half of the 22 million jobs that were lost in March have been regained. But unemployment has come down, but it remains a little bit high at 8.4%. Their median projection is for that to go down to 7.6% by the end of the year, and about 5.5% next year, and then maybe even 4% by 2023. But there is the prospect of inflation on the margin. This is obviously what the Fed wants. What they talked about in Jackson Hole last month was that they are going to keep rates lower for longer. In our chart pack this week, I actually published the latest Federal Open Market Committee, what they call a dot plot. And these are the estimates by the Federal Reserve or the Board of Governors, their own estimates. And so what they show is that there's going to be no substantive interest rate increase until 2023. So if you think about that, that ordinarily would be excellent feedstock for inflation, but we haven't had that much inflation. But the key thing is that the Fed is willing to let the economy overheat, and so you're starting to see inflation expectations build, and we've been layering in a little bit of inflation protection in the portfolios. But for some goods like food, there have been supply constraints that have led to higher prices, whereas on the consumer side, there's been weaker demand in some areas, so that's held down prices in some areas. But basically the median estimate for this year is about 1.2%, and maybe 1.7% next year. But I think there's a lot of people that have been surveyed that don't believe that we're going to get to the Fed's 2% inflation target for quite a few years, hence low interest rates for a long, long time. And but in any case, that's a little bit of conversation on the Fed. They're still calling on Congress to do more on the fiscal stimulus side. And of course, we just talked about the fact that there's, I think every day that goes by, there's a lower likelihood of having anything done on the fiscal stimulus side before the election. And so, revenues are dropping for, hard hit businesses, and we still have the revenue shortfalls for state and local governments, which really isn't getting a whole lot of press. But if you think about tax receipts and things like that fund essential services, those are clearly going to be impacted, but not getting a whole lot of press right now. So in other news, low interest rates, not too surprisingly. I think we talked about this last week, but and we actually had some charts last week in our charts of the week pack. But we've had a tremendous amount of refinancing, which has also led to more issuance of mortgage-backed securities. Banks have been getting a lot of deposits, so they've been buying a lot of these and holding them in their portfolio. And we also know that the Fed is buying a lot of these mortgage-backed securities as well. And just by way of I guess completeness here, refinancing was up 200% in the second quarter versus the same quarter last year, and just a tremendous rise. But interestingly enough, at the same time, again, with the stress in the lower tiers of the lower income tiers of our population, we've actually had a bump in delinquencies, and we know that there are a million plus borrowers that are past due by at least 30 days on their mortgages and are not in some sort of forbearance program. And so, we still have a lot of stress in the mortgage-backed market. We are seeing delinquencies, not just in mortgages, but also in other loan areas continuing to rise. We've already talked about the labor market to some degree. Initial claims have kind of stalled a little bit, and continuing claims are coming down a little bit, which is really good, but we just haven't seen a lot of progress on initial claims. That they are lower than they certainly were several months ago, but clearly well above levels that were in evidence earlier this year before the pandemic hit. So, obviously we've got some, we have some different dynamics going on in the market. As I mentioned, the equal weighted S&P is on pace for its best month relative to the cap weighted S&P 500 since 2009. So at least from a market standpoint, even with all of this uncertainty on the economic side, if you have much greater participation in breadth within the major index for stocks, that would be a real plus for the market, in my opinion. And then credit spreads on the bond side have continued to be tight, which kind of tells me that the markets are fairly complacent with regard to future credit erosion. So again, I think this, it's kind of a glass is half full kind of a situation where we know that there are delinquencies and such rising out there, but the market's still fairly confident that the overall credit profile of the economy won't significantly erode. So we'll just have to continue to monitor that. I talked about the mortgage market. A couple other points here. It's kind of interesting that despite the kind of the stalling in the labor market, that I guess some factories or some manufacturing entities say it's tough to find workers and tough to keep workers. And something else which was in our charts of the week pack at least a couple of times, including I think last week we talked about the risks incumbent with not having kids in school, and child care constraints are making it really tough to get people into the workplace, whether it be manufacturing or service industries. And so there's a very meaningful percentage of the population that is labor displaced because specifically of child care constraints. That's another oddity that has been born out of this pandemic. But just suffice it to say that I think some of the things that we need to be analyzing right now as we get closer to the election are what happens in certain environments. And I won't go into that here, but just kind of tee up a future discussion. In fact, I'm going to do a separate discussion on what I have researched as being the kind of key election implications, and we'll have a totally separate conversation just for that. But we know what the polls are telling us right now. We know the polls can be off, but we do know that if the polls are right, that that we've got perhaps $5 trillion of new spending coming if former Vice President Biden gets elected, and we know that it has to be paid for by additional revenue coming from taxes of all sorts. And so in that discussion, kind of that election preview, if you will, we'll go into that into some detail. But just looking at the broad market, we know what the landscape it looks like, we hope that there can be more continued progress on vaccines. I think the market is kind of holding its breath on good news. I do think the market is kind of overstating the prospects of getting a vaccine sooner. But the other thing that we need to be very cognizant of globally is the fact that caseloads for the pandemic continue to rise overseas, even if they do seem to be mitigating here. And we have seen a little bit of an uptick in caseloads as we've had more back to school, and we've kind of passed through that 2-week incubation phase for a lot of the reopening. So again, we'll have to monitor that and monitor the high frequency data, which I think is in many respects is kind of stalled out a little bit. So we're kind of hitting this September lull, and we do know that volatility typically does pick up in front of an election as people begin to analyze the what ifs and whatnot. But and the other thing, obviously, that we need to monitor is the status of these high cap, these large mega cap technology stocks that have had wide swings. So we're going to continue to watch that. But just looking at the health of the market, the S&P 500 trades at like 21 times last year's earnings, which were at a record. The long-term average price to earnings ratio is 15 to 16, and so we know that the market is a little bit hot right now relative to its historic average. And as long as the Federal Reserve continues to increase its balance sheet with mortgage-backed purchases and things like that, there's a historically strong relationship between the PE ratio, or the valuation in the market, and the Fed's balance sheet, meaning that when the Fed continues to expand its balance sheet, that multiples continue to expand too. So that coupled with the fact that the Fed's going to keep interest rates low for a long time does help prospects for stocks. But I do think that earnings are going to matter. I think the backdrop is going to matter, and I think we're going to have to really see how this data shakes out for the third quarter, in which we know that we're going to have a fairly decent bump in the economy on an annualized basis as we recover from that weak environment in the second quarter. Enjoyed the presentation this week. Please feel free to reach out to us at the information provided, and we'd love to hear from you. Questions, comments, cares, concerns. Hope you have a safe week, and we look forward to talking to you soon. Take care.